Hi, I'm Nik Broceta. I've been trading since year 2003. Through this course, we will not only explore the world of trading, but also get to know each other better. This course is based on a training script originally developed in 2006 by Forex Serbia team, a group of 6 top traders and portfolio managers from Serbia, together with a colleague from Jordan. I guide you through technical analysis, indicators, and platforms and show you how to become trader from choosing a broker to placing trades and withdrawing profits. Let's dive in. Where the action happens. Forex, foreign exchange market. The foreign exchange market is the largest and the most liquid financial market in the world, with over 7 trillion traded daily. Currencies are traded in pairs, offering 24/5 access and high volatility for active traders. Stocks. The stock market allows investors to buy ownership in companies and profit from price movements and dividends. Sorry. It includes exchanges like a New York Stock Exchange and Nasdaq, with trading primarily during business hours. Options futures are derivatives that allow traders to speculate on or hedge against price movements in various assets. They offer leverage and flexibility but require deeper understanding and risk management. In the practical part of this course, we will focus on the Forex market as it is the most volatile and active, providing countless trading opportunities. All the tools and strategies we learn are fully applicable to other markets as well. Okay, just a second. Forex, beginner's introduction. We will have introduction, Forex for small players, how Forex works, Forex and the stock market, introduction to fundamental analysis, tips for beginner traders, technical analysis, Japanese candlestick charts, trading practice. After the practice, we will talk about risk management and about brokers, platforms, how to install, how to buy, how to sell, how to withdraw money, and other. Okay, let's start. What is FX? What is Forex? Foreign exchange market, Forex, allows companies, financial institutions, and banks to buy or sell foreign currencies as needed and in large volumes. The main motives behind the demand for a supply of foreign currency are primarily related to capital flows through trade in goods and services, foreign investments, loans, and speculation of future exchange rate values. The market volume is enormous. For instance, as of 2024, the daily global trading volume in Forex is about 7.5 trillion, according to the Bank for International Settlements. Trading in the Forex market can occur on the spot or forward market, including swaps, futures, and options. Spot market transactions involve the actual exchange of currencies between buyers and sellers. Forward transactions are settled on future date, usually within 1 year, sometimes longer. Unlike the other financial markets, the Forex market is decentralized. It does not operate from a single physical location. Currency trading does not take place on a specific exchange floor. London is the largest global center for foreign exchange trading, with an average daily turnover of around 700 billion, roughly equivalent to the combined volume of the US, Japan, and Singapore together. London's dominance is due to its major role in international finance, including securities trading, commodities, banking, insurance, duty-free zones, and freight forwarding, as well as its time zone, which overlaps with Asia and America. Key players in the market are banks, companies, and brokers, as you know. Companies such as multinational corporations participate in the market due to foreign exchange currency demand from trade and investment activities. Commercial banks are the most active participants. They frequently trade with various financial institutions and corporate clients by phone, providing exchange rate quotes and executing trades. This script is from 2006, something like that. These informations are a little bit, I have to update them. Such practices are known as market making. Banks continuously quote by buy and sell prices, dollars for pounds, yen for dollars. They also trade on behalf of firms and often smaller banks. The third type of Forex market participants are brokerage and dealing firms, brokers, who act as intermediaries. By holding one currency, you essentially decide not to hold others. All your assets are exposed to fluctuations in your home currency's value. As the value of currency changes, so does the value of your investments, impacting your overall financial position. Many investors take advantage of exchange rate fluctuations to increase their capital. Today, supply and demand are the dominant forces behind currency values. Global developments, fall of communism, rise of Asia and Latin America have created new opportunities for currency traders. Increased global trade has made economies independent. Reports on inflation, unemployment, and expected events like natural disasters or wars affect current currency desirability. Major currencies like USD constantly fluctuate. This volatility has created the largest and the most liquid market in the world, the Forex market. Forex is an interbank and interdealer cash market, not centralized like the traditional markets. Trading happens via phone or computer worldwide. Historically, the Forex market was reserved for banks and large financial institutions, allowing them to profit while keeping the market semi-closed. Forex is a 24-hour global market accessible at all times except on weekends. Despite being global and liquid, time zones affect liquidity and trading opportunities for specific currencies. Main trading centers include Sydney, Tokyo, London, and New York. Events in any region can impact global participants within hours. Even in spot trading, time zones cause settlements to take 2 or 3 days. This 24 nature appeals especially to small traders. Skilled traders use both technical and fundamental analysis before entering any trade. We will talk about fundamental and technical analysis also. Fundamental analysis involves monitoring global news and economic indicators like interest rates, GDP, inflation, and employment levels. Trust in the government's economic management and occasional central bank interventions also affects currency values. Technical analysis popular since 80s use charts, trend lines, and patterns to spot trading opportunities in volatile markets. Forex for traders. It is up to the trader to decide whether to take a conservative or aggressive approach to trading. Before entering the market, the trader must adopt a trading approach. A conservative trader enters and exits liquid positions quickly and efficiently, taking advantage of small price movements and using limit and stop orders to manage risk. Limit order is used to automatically close a position at the desired price level once the market reaches that level. A stop order is used to automatically close a position at a specified price to limit potential losses from a trade. You will be seeing this a lot. Stock markets operate only on business days, typically from 9 a.m. to 4 p.m. If you are employed, you likely can't participate in day trading on the stock market, leaving you the choice: quit your job or avoid trading. Forex operates 24 hours a day, 5 days a week. You can trade anytime, even at night. The stock market has thousands of securities, making it difficult to understand why a particular stock rises or falls. About 85% of Forex volume comes from just 6 major currencies. This makes it easier to recognize patterns and price behaviors. In the smaller stock market, millions of inexperienced investors can heavily influence the price movements, making it more chaotic and harder to predict. Forex is the largest market in the world. The presence of many retail traders does not significantly impact the market. They cannot move it alone. On the stock market, profits usually come during economic booms when markets are rising. However, economic cycles inevitably bring a recession where profits become harder to achieve. In Forex, you can trade profitably during both recessions and booms. It doesn't matter whether the economy is strong or weak. News and fundamentals. Fundamental analysis studies currency movements on a macroeconomic level. It involves examining the full spectrum of socioeconomic relations within a country and internationally, especially those affecting central bank interest rate decisions. Traders get their fundamental information primarily from the news, which can be divided into unexpected, unplanned, or expected, scheduled events. Unexpected news includes political events, government resignations, wars, or something like that, or natural disasters. Expected news includes central bank decisions or interest rates and the release of economic indicators. Okay, this is yes. For example, war in Iraq affected oil supply, driving the up prices, increasing demand for dollar and weakening currencies of oil importing countries like Japan. Natural disasters also weaken the affected country's currency. Recovery efforts often require central bank money issuance, leading to inflation. Country's economic health is assessed through indicators like inflation, unemployment, and budget deficit. Inflation is a decline in currency value due to excessive money printing beyond the needs of goods services exchange. Okay, this is about fundamentals. I will skip that. Risk of investing. Fundamental analysis help traders identify market directions, trends, but is not sufficient to precise entry-exit decisions. For timing, traders must also apply technical analysis. Only trade with surplus capital, minimum $200, but now you can trade with $10 or something like that. You have these prop firms, you can trade without your money or with some small amount, but we will talk about that later. Losses should not affect your daily life or peace of mind. Focus on the market, not your financial situation. Stay calm and objective to make good trading decisions. Sorry. Yes. Never use your last funds for trading. The pressure will impair your judgment and increase the risk of the mistakes. These things are very important, guys. Let's hear them again. Only trade with surplus capital. Losses should not affect your daily life or peace of mind. Focus on the market, not your financial situation. Stay calm and objective to make good trading decisions. Never use your last funds for trading. The pressure will impair your judgment and increase the risk of mistakes. Don't rush into live trading without practice. Few days of demo trading will build confidence. Avoid comparing yourself to others. Everyone learns at their own pace. Practice develops your personal trading style. Once you consistently generate profits over weeks or months, consider going live. You will succeed as trader when your profits consistently exceed your losses and your account balance grows. We will talk about this more. This is very important. Uh, we will trade on demo accounts for start, and after that we will start with the live accounts and real money, but within smaller amounts for a start. Okay, long and short positions. Uh, Taking a buy long positions means the trader is purchasing a currency at a certain price with the expectations of selling it later at higher price. This is long. I buy here, I sell here. On the other hand, a sell or short position involves selling a currency in anticipation of a price this line, aiming to buy it back later at a lower price. When I mean short sell, I sell here, buy here, open position here, and close position here. What drives currency prices? Most trading activity in the currency market revolves around predicting the direction of future price movements. In general, a currency's value relative to others reflects the economic health of its country, while also considering the state of other major global economies. Currency prices are influenced by key factors such as GDP, interest rates, inflation, employment data, and geopolitical events. Although the Forex market is the most liquid of all financial markets, it's international in nature and operates 24 hours a day. The time of trading has direct impact on liquidity and the ability to trade specific currency pairs. The main dealer centers in the global Forex markets are Sydney, Tokyo, London, and New York. Traders must always be aware of which market participants are currently active because in today's highly interconnected financial world, events that occur within a single hour anywhere in the world can significantly impact some or even all participants in the Forex market. We'll talk about that. You will see that in at other time there is a bigger volatility on the market. You will see prices goes up or down on the London opening, New York Stock Exchange opening. You will notice that. Uh, okay, we'll talk a little bit about fundamental analysis. What is that? And just a second. Yes. It's better like this. We'll talk a little bit about fundamental analysis, but most of this script and our course is about technical analysis, about trading positions And this technical analysis you can use on stocks, on Forex. And Forex is most volatile market. And because of that, things that happen in 1 hour in Forex are happening on stocks for, let's say, 1 month or something like that. This trading, the best, the best type of, the best Forex is the best thing that you can trade and you can learn to trade. After that, you can trade whatever you want. Stocks, that doesn't matter. Options, futures, whatever you want. Cryptocurrencies, doesn't matter. But Forex is most volatile and you can practice on Forex. That is my advice. Okay, let's go. Fundamental analysis in FX. Fundamental analysis involves monitoring global news and studying specific developments that can influence currency price fluctuations. This includes monetary and fiscal policy, political stability, trade routes, and the key economic indicators such as GDP, CPI, PPI, interest rates, inflation, and unemployment figures. Confidence in the government's ability to support its national currency also plays a role in determining exchange rates. From time to time, central banks intervene directly in the market as an effective tool to keep currency exchange rates within a comfortable zone. Uh, It is up to trader to decide whether to enter trades with moderate or the increased risk. Before initiating a trade, the trader must define their approach. By choosing a moderate risk strategy, the trader enters and exits position quickly and efficiently, taking advantage of small price movements while using limited stop orders to manage risks. I think that we already told this, but it doesn't matter. The most important economic indicators that reflect the overall health of a country's economy are published regularly in the standardized forms for traders, include Consumer Price Index (CPI) measures retail price inflation. Producer Price Index (PPI) tracks price changes in the industrial goods. Unemployment rate shows the percentage of the workforce without jobs. Non-farm payroll reports the NFP and reports the number of new jobs added. Trade balance, the difference between exports and imports. Gross domestic product, GDP, total value of goods and services produced. Money supply, the total amount of currency in circulation. Oil and energy prices influences inflation and production costs. Stock market indices, general indicators of economic confidence. Okay, we will talk about few sentences about each of these indicators. Consumer Price Index (CPI) is a key measure of retail price inflation. It reflects changes in the prices of goods typically found in the standard consumer basket. An increase in the CPI, rising inflation, usually leads to higher interest rates, which in turn strengthens the national currency. PPI, Producer Price Index, measures changes in the prices of goods intended for further production, also known as intermediate or wholesale goods. It affects the value of currency in a similar way to the CPI, as rising producer prices may signal future inflation and lead to higher interest rates. The unemployment rate represents the percentage of the labor force that is actively seeking work but currently unemployed. Higher unemployment usually signals economic weakness, which may lead to lower interest rates and decline in the national currency's value, while lower unemployment supports currency strength. Non-farm payroll measures the number of the new jobs added in the U.S. economy, excluding the farm workers, government employees, and the workers in non-profit organizations. It is one of the most influential economic indicators, as strong job growth often leads to higher consumer spending, potential interest rate hikes, and a stronger currency. Money supply refers to the total amount of money, cash, coins, and liquid assets available in the economy at a given time. An excessive increase in money supply can lead to inflation and currency devaluation, while tight control over money supply tends to support currency strength through stable price levels. Oil and energy prices play a crucial role in the global economy as they directly affect production costs, transportation, and inflation. For countries that are net importers of energy, rising prices can weaken the national currency, while energy exporting nations often see their currency strengthen as commodity prices rise. This logical fundamental analysis helps traders identify the underlying direction and long terms in the market. However, when it comes to pinpointing the exact timing of entry or exit in the Forex market, fundamental analysis alone is not sufficient. To determine the precise moment to buy or sell, technical analysis must be used in a combination with fundamental insights. Okay, let's say now, currently, Fundamental analysis is telling us that US dollar is weakening. Sorry about my English. And gold is going up, Bitcoin is going up, and that is the general trend. And for me as a trader, in that case, I'm looking for long or buy positions on gold, on Bitcoin, or short positions on dollar. And technical analysis helps me to pick the right spot, as you can see, to pick the right spot on the market to enter the trade. As you can see, this is gold chart. These are my trades. My buy and sell. Blue is buy, red is sell. I was opening. I'm looking to enter because trend is buy. Trend gold is going up. I'm waiting for you see like this places like this to buy. Okay, but we will talk about that. Okay, this is that will be all for the first part of this. Okay, we will talk a few more slides about strategies, and after that, the other part will be technical analysis. Technical analysis is my favorite, and I will talk about that. I'll be very happy to talk about that. Okay, strategies for success. Start with demo account. Practice trading without risking real money to understand how the market works. We will first open demo accounts. We will start trading on demo accounts to buy, sell, close, trailing stops, limit orders, stop orders. Um, I will show you. You will trade on that demo account first few days to know to get know the platform and everything to choose the platform you prefer or another. Focus on one market at a time. Don't overwhelm yourself. Master. Sorry, let's do it like this. Okay, sorry. Start with demo account. Practice trading without risking real money to understand how the market works. Focus on one market at a time. Don't overwhelm yourself. Master one currency pair or asset class before moving on to others. Use a trading plan. This is really important. Set clear rules for entry, exit, and risk management, and stick to them. I have a lot of mistakes here. Okay. Control your emotions. This is really important. Discipline beats emotion. Avoid impulsive decisions driven by fear or greed. This is problem for every trader in the beginning. Risk only what you can afford to lose. Never trade with money you can't afford to lose. Preserve your financial stability. Keep learning. Markets evolve, so should you. Stay updated and keep educating yourself. Technical analysis. That's it. We will stop for now. Thank you very much and welcome to FX Doctor Traders course. I am looking forward to technical analysis. That's it. Goodbye.